Hello, this is Dr. Mankiw. Throughout the course of the semester, I will be posting a series of short videos as necessary, either to cover key concepts or to go through some of the calculations in a little bit more detail. So if you ever need anything else included in these videos, please don't hesitate to reach out, and I can usually record something without too much trouble. So one of the main goals of the first two chapters is to sort of review a lot of the things you talked about in Principles of Macroeconomics. In particular, refamiliarize yourself with the key economic indicators like GDP, inflation, and unemployment. And I'd really like you to have a handle on the basic story of the U.S. economy since the Great Depression or so. So, what has been the story with GDP and unemployment and inflation? And there are a couple of different time periods and key events that you should be aware of as well. So throughout the course, you're going to see lots of what we call time series graphs, like the one you see in front of you here. So this is a time series graph that looks at the performance of real GDP over time since about 1900 through the current time period, roughly. Two words in this title here that you need to be aware of. Real means that we are adjusting for prices over time. So we're looking at actual production of goods and services. So this is not just about prices going up. And per capita means we're looking at this in terms of per person values. So how much stuff are we producing per person over time? Real GDP per capita is the standard way that we measure the standard of living in an economy. So the more stuff, the more goods and services per person that we are producing, the better off we are in a material sense. So when you look at this graph, there are a couple of things that you should immediately notice. So one is that over time, what is the long run trend here? What is the big picture? Well, the long run trend is that over time, we're becoming more and more well off, economically speaking, materially speaking. GDP per capita is on a long upward march over time. So we call this long upward march over time economic growth. So really we can talk about macro and sort of different time horizons. So when we're talking about the very long run, usually we're talking about economic growth. Now, when we zoom into different time periods like 1929 to 1935, for instance, we're talking about the ups and downs of the economy. So GDP fluctuates around that long run trend. So even though we have growth over time, we certainly have episodes like the Great Depression here, 1929 to 1932 or 3, that GDP is not increasing, it's declining substantially. So those are referred to, the study of the short run sort of fluctuations is called the study of the business cycle, recessions and expansions. And so as I mentioned initially, one thing I want you to be able to do is to sort of recount the basic economic history of the United States since the Great Depression. So if you had to characterize this in a general sense, you would notice that prior to, say, 1945 or so, the fluctuations, the ups and downs, seemed to be more severe. And then we sort of hit a period of tranquility, and then sort of another little rough patch, and then a long period of sort of uninterrupted growth up until we get to this financial crisis. So this long period of uninterrupted growth from about 1985 to 2008, we call the Great Moderation. So you can see the business cycle is less severe, not many downs, it's pretty steady upward climb. And so this led a lot of people to sort of think that, well, economists have this all figured out and we've conquered the business cycle. We had a small recession here in 1991, a little tiny dip. Another little tiny dip after 9/11 and the crash of the tech stocks. But really up until we hit the period of the financial crisis in 2008 to 2010, when we sort of realized that we did not have this all figured out. But then again, the story is after a dip, we generally see a recovery and an upward climb once again. Okay, and so to summarize the things that you should be focusing on here. So notice the huge decline in output with the Great Depression. So this is one of the most important episodes in the history of the United States. So this led to lots of the policies like Social Security and federal deposit insurance. Things that we see today were born out of this Great Depression. This is also really when macroeconomics became a focal point of economists at large. Prior to the Great Depression, macroeconomics really wasn't a focus. It was sort of a hands-off approach. The economy is going to do what it's going to do, and there isn't much we can do to fix things. But then the Great Depression changed all that, and policy became very much more about intervening and stabilizing the economy. So after the Great Depression bottomed out, we call this the trough of the recession. Started to figure things out from a policy perspective and had growth. Another hiccup here. But then World War II hit, and production just really took off. So by about 1940 or so, we were back up to the sort of trend that we had before the Great Depression. But then with the war, production, goods and services were produced at an extremely fast rate, and we went way above trend and recovered from this sort of wartime economy where we returned to normal, back down to, again, this long-run trend approximately. And then had a relative period of stable prosperity through the 50s and early 60s, and then lots of turmoil in the 70s. So we had the Vietnam War, we had price shocks that were due to disruptions in the global oil market, and also just the way that we were running policy in the United States. But this led to very high prices in the 1970s, and there were price controls and all sorts of crazy things going on in this time period. So, so this period is often referred to as the Great Inflation, another important time period. And then this led to a drastic policy change in the early 1980s. So this is when we started to get serious about monetary policy and fighting inflation. And so the new Fed chair, Paul Volcker, in late 1979, instituted a very stringent interest rate policy that caused a dip in production. It caused back-to-back recessions in the early 80s. But since then, we've had a relative period of stability all the way up until the financial crisis of 2008 through 2010. More growth, albeit a little bit slower, and sort of characterized by high unemployment for quite a long period of time. And now, if we were to extend this out to the COVID area, again, you'd see a substantial dip in production, and then a quick recovery after the economy normalized after COVID. All right, so moving on to the next key macroeconomic indicator, inflation. So you probably remember inflation has to do with prices. So this is the growth rate of prices over time. And so one of the things I'd like you to be able to do is sort of match up these time periods on this graph with what's happening in the other graph. So we should be able to put the whole puzzle together and have a coherent picture of what's going on with these different variables. Notice the y-axis in this graph. So it's a little bit different than what we saw in the GDP per capita graph. So notice we have some negative numbers and we have some positive numbers, and we see that inflation sort of goes, sort of up and down around this zero line here. So zero inflation means that prices are staying the same over time. So the basic story is that prices are not staying the same over time, and they've been pretty volatile during this period of 1900 to sort of 1980 really, but even more volatile during the early years prior to the Great Depression, during the Great Depression. And we see that there were a couple of episodes where prices were actually declining. We call this deflation, when prices are actually getting lower over time. It's a negative growth rate. So deflation was actually fairly common prior to 1940, but after World War I, you don't really see this line get below zero anymore. So deflation sort of became a thing of the past. And we will talk more about that later. And so a couple things to notice. So what happened during the Great Depression here? So for instance, we had a big decline in production, and we also had a big decline in prices. So this is really a sort of simple supply and demand story to some extent. Remember, what determines prices in the supply and demand model? Well, if you have high demand for goods and services, prices will tend to rise. If you have low demand, then prices will tend to fall. And so that's a big part of the story here. And during the Great Depression, is there was low demand for goods and services, incomes were low, and so prices tended to go down as well. So now, normally, what would happen in today's policy era is that if we see prices declining like they were in the Great Depression, we would have severe monetary policy action that would be taken to prevent that decline in prices. But here we didn't really have that until well into the Great Depression, when policymakers started to realize that yes, we really needed to combat this inflation, or to combat the deflation, and had some more aggressive monetary policy expansion of the money supply. So remember that period of turmoil in the 70s. So we had the oil price shocks, and we had the Vietnam War. So this is a period of pretty steadily rising prices. Again, this is referred to as the Great Inflation. So after the wartime economy sort of normalized, we had relatively low and stable inflation, and then this big rise. And then the policy regime change in the 80s with Paul Volcker coming in as the new Fed chairman, and really attacking this inflation, increasing interest rates to drive down demand and prices. And so that sort of caused those recessions that we looked at in the early 80s, but it also led to lower prices. And then this regime of relatively low and stable prices since then. In fact, prior to COVID, some were concerned that inflation was too low. So the Fed historically has tried to keep inflation around 2%. And so there were several periods here where we dipped below 2%. That's not the case anymore, as you probably are well aware. So as the economy has started to normalize post-COVID shutdowns, we've seen bottlenecks, and we've seen lots of supply disruptions that have caused prices to increase. And so now the big question is, this rise in prices we're seeing, is this more of a permanent thing, or is this a transitory thing that's due to the COVID supply disruptions, or is this more of a fundamental monetary policy issue? And so that's going to be an interesting thing to analyze going forward. And finally, just to summarize the story since the Great Depression. So we saw these wild fluctuations in output in the previous slide, and that also led to these big fluctuations in prices on this side. As the economy was in recession, prices tended to fall. Prices tended to rise as we recover from the recession. And here, when the economy was booming because of World War II, prices were tending to rise. We sometimes call this when the economy is heating up or overheating, prices tend to rise. And then the post-war return to normalcy, then a period of relative stability that we talked about in the 50s and early 60s. And then this sort of turmoil of the 70s with the Vietnam War, the supply shocks in the oil market. And as we'll see later, it was just sort of a result of bad policy as well. And then sort of the entrance of the Great Moderation, after we sort of got a hold of monetary policy and created this long period of stability, up until this big disruption with the financial crisis. So when output declined in the financial crisis, we also see that prices declined again with it. Prices rose again after the economy recovered. And then we sort of see these the spikes that are more recently. If we could continue this off a little bit, we would see this spike up again with the COVID economy. All right, so I've already talked longer than I wanted to, but let's get to this last time series graph here. So this one looks at the unemployment rate, and again, we should be able to match up the story, the historical events that we saw in the other two slides. We should be able to tell the same story here. So the unemployment rate is the percentage of the labor force that is not working. So remember, the labor force is only consists of people that are either working or trying to work. So people that are not trying to work, like retirees or students or discouraged workers, are not counted in this unemployment rate. So again, same sort of story. Prior to World War II, we had lots and lots of volatility. Since then, we still have volatility, but not quite as much. So during the Great Depression, during the Great Depression, when output is declining, what happens to unemployment? Well, it rises. We're not producing as many goods and services, so fewer people are needed to produce those, and so we see layoffs and a rise in unemployment. People can't find work. And so people that study the short-run fluctuations, this is one of the key things we're concerned about, because this causes a lot of pain and suffering when people are not working, financial distress, psychological distress, etc. So as the economy recovers from the Great Depression, unemployment goes down, but we had another downturn, and then finally with World War II, unemployment goes to sort of historical lows, with everyone either fighting or working in the economy back home that's booming to produce the war goods. So we did tend to see unemployment sort of creep up on average. So again, we can talk about the long run trend has sort of been these wild fluctuations, and rising and then falling, and then sort of rising and then peaking, and then maybe perhaps falling a little bit most recently. So let's match up. So we had relatively low stable unemployment, around 3 to 5%, 3 to 6% in the 1950s. Then we saw unemployment creep up in the 1970s with that turmoil. And then in the early 80s, really spike up high to 10%. And so this was the highest unemployment since the Great Depression. Again, this was that attempt to get control of those prices. We saw unemployment spike up with those recessions, and then sort of go back down to more normal levels, 4 to 6%, during the Great Moderation. And then the financial crisis, again, unemployment had a huge spike, so nearly matching the 10.8% that we saw in the early 80s, and then, of course, recovering since then. And so this would be a wild story during COVID too, because we'd see a big spike in unemployment during COVID, and then a quick return as the economy opened back up again. So I'm going to wrap it up there. But again, the key things to understand is how these variables all fit together. When one of these variables is moving in the other graph, we're going to see a predictable movement in these other graphs, right? So if GDP is moving in one direction, we know unemployment is going to likely be moving in the other direction, and similar with prices. And so understanding the historical events that cause these changes in the variables is very helpful as well. And then, of course, understanding the policy changes that were driving these things as well. So a good example of that is the early 80s. So with that, I'm gonna stop talking, and please let me know if you have any questions on these graphs. But again, if you're having trouble reading, interpreting, understanding these graphs, you need to reach out to me, because these are pretty crucial, and we're going to be seeing time series graphs over and over and over again throughout the course of the semester.